Be greedy when others are fearful, and be fearful when others are greedy. It makes sense, right? It sounds pretty rational, but some people take this a little bit too far. There is, for example, the Fear and Greed Index. And does that index really work? Let's have a look at the data. So what we've got over here is Bitcoin's price development in the last 6 years. So that's the line in black. What we also see here in red and green is the Fear and Greed Index. And when this is green, people are greedy. When this is red, people are fearful. Now, if we were to sell each time when people are greedy, then we would have missed out on a rally, for example, over here from 15K all the way above 60K. If we were to buy each time when people were fearful, for example over here, then we would have bought over here at 7 to 8K and moved all the way down to 3.5K. The issue with the indicator is that it's oscillating too quickly. It might work to a degree if you're a very short-term speculator. But if you try to time the macro somewhat, then the Fear and Greed Index doesn't work. Here's another popular approach that I'm not too convinced by. It's plotting the Bitcoin price based on a logarithmic regression. So it seems quite reasonable, right? We buy whenever we are low in the trend channel, we sell whenever we are high. And currently we are somewhat in the middle. Bitcoin would be cheap between 25 to 33,000 and it would be expensive between 220 and 300,000. The problem with the approach is that we're drawing this kind of trend channel after the fact. There are different versions of this model. For example, check this out. This is an older version of the model. The fitting is slightly different. We would have completely missed selling at around the 60K mark because one would have expected to go all the way up to 130K. And one might even have panicked over here in November of 2022 because this very last line, this purple line, was actually added as a second step to this model. There was no purple line before. We tended to already bottom out at the blue line. The purple line had been added because the depression in 2022 was larger than people expected. And what then afterwards happened again was that the slope was adjusted and that it then looked like the system somewhat worked when Bitcoin was around 60K. But in actuality, it didn't work. In actuality, people expected the price to rise further. And if you look at even older fittings of that model, we can see how easily this can break. So this was fitted in 2019. Then it broke out during the COVID crash, and then it finally broke out during FTX. Here are the videos that work on YouTube. XRP will be $12,000 guaranteed, or an AI explosion, top 3 cryptos to buy in November. A lot of pushing of greed, that's what gets the clicks. What doesn't get the click is a tutorial on how to make backtests, on how to build those sheets that in the end figure out what historically worked well in the past. The backtest that I often show here on this channel. I still very much enjoy producing this kind of content though. I also share these kinds of sheets, but I don't do it on YouTube. You also get direct access to me. Feel free to check it out. It's thebitcoinstrategy.com. So when the Fear and Greed Index doesn't work and when the logarithmic regressions doesn't work, what actually does work? What I personally like is reference prices. I like to trade based on psychology because I believe this is how crypto works. Everybody has their entry price, right? You buy Bitcoin or you buy crypto at a certain price, and then you look at the new price relative to your own price. So when you're a lot in profit, you consider selling at that profit. If you're a lot in losses, you might keep on holding because especially if it's an asset that you believe will appreciate over the long term, why realize the loss if you don't have to? And so that reference price is very important for us, but we can broaden this out. We can look at the reference price of the entire market. And there's 2 ways to look at this. One is the realized price. Another one is the net unrealized profit and losses. Let's start off with the realized price. So this is the average cost basis of the market as a whole. Right now, the realized price of Bitcoin is at 31,420. So your average Bitcoin investor is almost 2x in profit. Historically, it would have been a very good time to always buy whenever the market in aggregate is in losses. Because again, that tends to be the time when people simply keep on holding and waiting for a recovery. Right now, we are not in such a situation. Right now, if we are unlucky, we could drop quite a bit further from here. Another way to look at this in a very similar fashion is to look at the net unrealized profit and loss. When the blue line is in the green area, the market is in aggregate in losses, and that's a very good time to buy. When the blue line is in the red or in the orange area, it tends to be a better time to take profit. Because when we are in the orange area, the market in aggregate is up to 75% in net unrealized profit. And that might be the time when people take the profit. And so it's very interesting how over time we tend to oscillate between the two extremes. And currently, again, we are unfortunately not very low on this metric. The market used to be a lot in profit. Now it's slightly less in profit. Are we going to see a secondary rally up? I don't know. But it does appear based on those metrics that Bitcoin could potentially also still fall from here. So it's very important to have some kind of risk management here. You don't want to be 100% in crypto, right? You do want to be prepared that in case we do see a crash, right? In case Bitcoin suddenly goes down 50%, that you can actually take advantage of that crash. So if you don't yet have a lot of wealth relative to your income, then it might make sense to simply just hold that dry powder in cash. If you do have a lot though, then it might make sense to put this into other assets that are lowly correlated, namely some stocks, namely long-term government bonds, maybe gold, maybe even some property that's somewhat liquid, right? Maybe in a high-rise apartment building where there's a lot of transactions. You do want to have something that has very little correlation that will not crash in case Bitcoin does. Because again, there is the possibility that at some point in time, the market in aggregate will be in losses again. And that's actually the time when it makes sense to double and triple down. And historically, those kinds of moments happened roughly every 4 years. So it could happen in 2025 or 2026. If you got something out of this video, feel free to give this a like. It helps the channel grow. Feel free to also subscribe. I publish videos regularly on this channel. In case you've got Telegram, then you are more than welcome to join us. The link is down below. Looking very much forward to chatting with you.